The average actively managed fund charges you more money and still loses to a fund a robot runs. Not sometimes, not in bad years, consistently, over decades. And most people are still handing their money to the expensive option, wondering why their portfolio never seems to catch up. Welcome back to Money Straight Talk. Today we are breaking down 5 specific index funds that have outperformed roughly 90% of actively managed funds over the long term. We are talking real tickers, real numbers, and real reasons why these boring funds are quietly making regular people wealthy while Wall Street charges you for the privilege of losing. If you have ever wondered where to actually put your money, this is the video for you. Let us start with the one that started it all. The Vanguard 500 Index Fund, ticker VFIAX, tracks the S&P 500. That is the 500 largest publicly traded companies in the United States. Apple, Microsoft, Amazon, all of it, in one fund. Now here is the number that should stop you cold. Over the past 20 years, more than 90% of large-cap active fund managers have failed to beat the S&P 500. Not a handful, not most, over 90%. And what does VFIX charge you for this market-beating performance? An expense ratio of just 0.04% annually. That means on a $10,000 investment, you pay $4 a year. Compare that to the average actively managed fund at around 0.66%. That difference sounds small until you run the math over 30 years. On a $50,000 investment growing at 8% annually, the fee difference alone costs you over $60,000 in lost compounding. VFIAX is where most people should start. It is the foundation. Everything else builds on top of it. Now let us talk about total market exposure because the S&P 500 only gives you the big guys. The Vanguard Total Stock Market Index Fund, ticker VTSAX, goes further. It holds over 3,700 U.S. companies, including mid-cap and small-cap stocks. Small-cap stocks have historically delivered higher long-term returns than large caps, though with more volatility along the way. VTSAX captures that upside while keeping costs almost identical at 0.04%. Here is what makes this powerful. When small and mid-cap companies grow into large caps, you own them the whole ride up. You are not waiting to hear about them. You already hold them. Jack Bogle, the man who invented the index fund, called total market investing the purest form of owning American capitalism. Hard to argue with that. VTSX has returned an average of approximately 10% annually since its inception in 2000, including the dot-com crash, the 2008 financial crisis, and the COVID collapse. It weathered all of it, and it kept compounding. Point 3 is where things get interesting for people who want international exposure. The Vanguard Total International Stock Index Fund, ticker VXUS, gives you access to over 8,000 companies across developed and emerging markets outside the United States. Europe, Japan, China, India, Brazil, all in one fund for an expense ratio of 0.07%. Now, a lot of U.S. investors skip international exposure entirely. That is a mistake. U.S. stocks have dominated for the past decade, but history tells a different story over longer periods. From 2000 to 2010, international stocks actually outperformed U.S. stocks by a significant margin. Nobody knows which region will lead the next decade. Owning both means you are covered either way. A common portfolio framework called the 3-fund portfolio uses VTSAX, VXUS, and a bond fund together. That combination gives you essentially the entire global stock market at near zero cost. Roughly 55% US, 35% international, 10% bonds depending on your age and risk tolerance. Simple, diversified, historically very hard to beat. Let us talk about growth now because if you are in your 20s or 30s, you have time on your side and you might want more exposure to the companies driving the future. The Invesco QQQ Trust, ticker QQQ, tracks the NASDAQ 100 index. That is the 100 largest non-financial companies on the NASDAQ exchange. We are talking NVIDIA, Meta, Tesla, Alphabet, all concentrated in the technology and innovation sectors. Over the past 15 years, QQQ has returned approximately 18% annually. $17,000 invested in 2009 would be worth over $170,000 today. The catch is volatility. QQQ dropped roughly 83% during the dot-com bust. It dropped about 32% in 2022 alone. This is not a fund for someone who panics during downturns, but for a long-term investor who can hold through the noise. QQQ has been one of the highest performing index products in history. The expense ratio is 42%, a little higher than Vanguard products, but still a fraction of what any active manager charges. If you want to tilt toward growth, QQQ earns its place in a diversified portfolio, just not as your only holding. The fifth fund is one most people overlook, and that is a mistake. The Vanguard Real Estate Index Fund, ticker VGSLX, invests in real estate investment trusts, also called REITs. These are companies that own income-producing properties, office buildings, shopping centers, apartment complexes, data centers, hospitals. You get real estate exposure without buying a property, dealing with tenants, or getting a mortgage. REITs are required by law to distribute at least 90% of their taxable income as dividends. That means VGSLX generates regular income while also giving you price appreciation over time. The fund has returned approximately 8 to 9% annually over the long term and carries an expense ratio of just 4.12%. Real estate as an asset class has historically had low correlation with stock market movements, which means when stocks drop hard, real estate does not always follow. Adding VGSLX to a portfolio of stock index funds can smooth out volatility over time while adding an income stream. Most investors in their 30s would benefit from having 5 to 10% of their portfolio here. It is one of the most underrated moves in passive investing. Here is the bigger picture before we wrap the fund list. The reason index funds win over time is not luck. It is math. Every time an active manager makes a trade, there are costs. Bid-ask spreads, transaction fees, tax drag from turnover. The average actively managed fund has a turnover rate of around 80% per year, meaning it replaces most of its holdings annually and generates taxable events constantly. Index funds have turnover rates closer to 3 to 5%. That difference compounds quietly in your favor year after year. Warren Buffett has said publicly that when he dies, the instructions for his wife's inheritance are to put 90% in a low-cost S&P 500 index fund and 10% in short-term government bonds. That is not a strategy for someone who does not know better. That is a strategy from the greatest investor alive for someone he loves. The 5 funds are VFIAX for S&P 500 exposure, VTSAX for the total U.S. market, VXUS for global diversification, QQQ for technology and growth, and VGSLX for real estate income. You do not need all 5. You might only need 2 or 3 depending on your goals and timeline. But understanding each one means you can build a portfolio that is genuinely suited to your situation instead of just guessing. If this broke something open for you, share it with someone who is still paying high fees on managed funds or sitting in cash wondering what to do. Join our community for more content like this, delivered straight with no jargon and no agenda. Every week, we bring you the conversations about money that most people are never taught to have. One more thing. If you want to actually implement everything we talked about today, check out M1 Finance. It is the platform we recommend for building index fund portfolios without trading fees or minimums. You can set your target allocations, automate your contributions, and it rebalances for you automatically. It is genuinely built for exactly this kind of long-term passive investing. The link is in the description, and using it directly supports this channel at no extra cost to you. Next week, we are getting into something that makes people uncomfortable. The truth about retirement accounts, specifically why maxing out your 401k first is not always the right move and what to do instead. That one is going to shift some assumptions. Stay locked in.